Welcome everyone to tonight's asset protection webinar. We are delighted to have Scott Estill with us, former senior trial attorney from the IRS. He is absolutely brilliant at taxes, and our students, I think, look forward to him more than any of our other speakers. Scott, thank you for being on. Before we turn time over to him, I wanted to announce just a couple real quick things. Number one is if you're brand new to this, I know we've done a lot of internet marketing. If this is your first experience with us, this is a part. This is only one webinar in a huge series of webinars that's been going on for over 10 years. And we've had some really incredible webinars so far this year. And in fact, we had one 2 weeks ago. It was investor strategies for any market. This was Mike Koval, and he offered a really unique opportunity to do a 2-day live class with him. And I talked to Mike a little bit earlier today. He still has 4 or 5 slots still available for that class. His class is coming up this weekend. If you did not get a chance to listen to that investor strategy for any market webinar, I invite you to go to YouTube. It's our YouTube channel, youtube.com, and look under Protect Wealth Academy. And his will be one of the very top webinars that's on there. Go ahead and listen to that. If you're interested in signing up for his program, I think it was like $199 or something. That was an unreal class. This is the same class he's charged thousands to attend in the past. And it's a little different than what our students have purchased at the summit, but it's incredible content. Anyway, if you're interested in that, look at that webinar on the YouTube channel, and that should give you all the information. But that class again is this Saturday and Sunday, so don't delay on this one. Sign up for it tonight or tomorrow. And we hope somebody takes those 4 or 5 slots. I hate to have them go empty. Anyway, but tonight, Scott Estill, tax planning before you file your taxes. And then coming up soon, we've got some really good webinars that are in the planning. So watch your emails, and we'll keep you informed of what's happening in the future. We're 2.5 weeks away now from the 3-day Asset Protection Summit, of which Scott will be a very big part. But we've also got Dr. William Danko, author of The Millionaire Next Door, and his new book, Richer Than a Millionaire. We've got Mike Koval, who'll be on, Clint Coons, Stacy Acevedo. We've got some amazing people, and we just signed up Qbi Granderson, one of the most brilliant attorneys I've ever met. Top of his class, Harvard Law School. He's raised over $1 billion in venture capital, and his message is thinking like a millionaire. I've never seen anybody walk into a room and attract a crowd. You just know that he has money. You know that he attracts money. His thinking, and so we've asked him to come in and say, how do you approach people when you're looking for money? And he's not looking for a few dollars. He's raising hundreds of millions of dollars at a time. Kwame, what's your thinking as you attract millionaires? He's multimillionaire. I don't know how many investment properties, mobile home parks, commercial real estate that he owns, but he's a big player he's a big player. And so we've invited him. We're excited to have him. If the summit we've got coming up in 2.5 weeks is a Thursday, Friday, Saturday event. This is April 22nd, 23rd, 24th. So Thursday, Friday, Saturday. If you haven't registered, go to protectwealth.com. And we still have room because this is a Zoom event. It's not like we're going to shut it off because there's no room in the ballroom anymore. But sign up for that as soon as you can, because our limitations on Zoom, we kind of like to know how many to plan for. That would be helpful. If you can't attend that one, the next one will be a live stream event in June. This is a Monday, Tuesday, Wednesday class, June 14th through 16th. And then in the fall, we're going to start, COVID permitting, we're going to start having live events again. So Orlando in September and hopefully Las Vegas in November. So that's sort of our schedule coming forward. Looking forward. If you'd like a copy of our agenda, it'll be available on protectvault.com. The one for this coming in 2.5 weeks, the agenda has not been posted. There's a sample agenda available on our website that will be fairly close. The exact one probably won't be posted until Thursday or Friday of this week. All right. And then before we turn time over to Scott, there's always a disclaimer whenever we talk tax and legal, and that is we cannot give specific tax advice. We can talk general principles. We can teach general concepts. Scott will be very true to the tax code, and here's what the courts have taught. But how those principles apply to you and your situation is really a chance for you and your accountant, your CPA, your attorney to sit down and discuss specific strategies that work for you. And so with that, Scott, I'm excited. You're not any longer preparing taxes, but you're still a consultant and you still advise people, and especially our students. We love having you on our stage, and really looking forward to this topic tonight. So Scott, with that, I'm going to turn time over to you, and Kendall and I will be here. And at the end, I assume that we'll do like you normally do. You'll teach for a little while and then ask questions or answer questions at the end. Is that kind of our format?
That was my plan tonight, if that still works for you, Don.
So if you have questions, hold on to them. And then we may not be able to get to all of our questions. We're limited on time. And you know, so type in your questions as soon as you don't type them in as soon as it comes into your head, because let Scott go through his presentation. There's a good chance that he'll answer your questions as we go through the presentation. But as soon as we get close to an end, start typing in your questions. We'll get to as many questions as we possibly can in the time allotted. So Scott, with that, let's turn time over to you. Thank you for being here. We so appreciate you and your time and your expertise. So with that, I'll shut up, and because
Thank you.
Students didn't come to hear me. There you go.
Thank you so much, Don. Are we good here as far as my screen sharing, audio, everything good?
Can see the screen. Yes.
Okay, perfect. And one thing I would like to mention before I jump into this is for any of the questions, if you could keep the questions limited to the material that I'm talking about tonight. A lot of the questions can get pretty convoluted and what have you. And so let's try to keep them focused in on what I'm going to be talking about for the next, say, 40 minutes or so is not only the 2021 tax day planning, which, in most years that would be coming up in 9 days or so. This year it's been extended out to May 17th, but some of the thoughts on what can we do now? What can we do today to be able to, get our tax bill down, but also to get a handle on the taxes themselves. And so, as a lot of you have seen me speak before, we have several hundred people on this particular call tonight. But I've really devoted my time since I left the IRS. Now, what was that, back in 94? So quite a while ago, 27 years outside of the IRS, I've devoted my professional career to being able to educate people on what can we do to beat the IRS, right? What can we do to at least have a chance in the tax game? And that's really what it is that we're all playing, because to me, this slide here is one of the more offensive slides, I think with taxes in general. And this is, I'll be scribbling down here in some red tonight, but April 16th was last year's Tax Freedom Day. We're not there yet. But what that means is that for the average American last year, and this year is going to be very similar in the date, we had to work all of January, February, and March, and in this case, 16 days in April before we end up working for ourselves. So far this year, everybody on this call, if you're the quote unquote average American, you haven't made a dollar yet for yourself or your family. Everything that you've worked for up to this point, and again, for the next week and a half or so, is going to be to pay your taxes. So I think that kind of sets the stage as to what we're up against here. And, Don every year has asked me to, come do a presentation somewhere around April 15th, whether it's live or whether it's, a virtual video type event like this. But it's really difficult to do anything about 2020 right now in this retroactive tax planning. The first thing, and this came about just last month, is that some of the unemployment compensation that was received last year, so if you received something last year, the first $10,200 is not taxable income if your income was less than this 150. So I've seen, and I've gotten a fair number of questions up to this point of, hey, my income was, $80,000 last year. I got $5,000 of unemployment compensation and I reported it as income. Well, the reason you report that as income is because it is income. And it was income until, like I said, back in March of this year. So if you've already filed and you're entitled to getting this $10,200 or up to that off of your tax bill, the IRS has said that they are going to go through and correct those returns. Now, that is probably the case, but make sure that if you're entitled to this, if the IRS doesn't correct it, then go ahead and amend your return. This rule, as of today, does not apply to 2021. So all of unemployment compensation received this year is going to be taxable unless they change the law again, right? So what can we do? Well, not a whole lot to be able to, again, go back and affect our taxes for last year. We can contribute to an IRA, and the IRS has said that in most years, this would be tax day. In this year, it's also tax day. So we've got now an extra month up until May 17th to contribute to an IRA for 2020. Same thing with a SEP, okay, which is a simplified employee pension, by the due date of the return, including extensions. So this is one where if you know what your tax bill is going to be, let's say in 2020, and you don't like it, and you haven't contributed to a 401k or a SEP plan or what have you, you still have time to do it. Now, there was a question that I got before this webinar. James asked me a question on what about conversions? Can I convert today and make it retroactive? And the answer to that is no, you can't. So this is only for current contributions. If you're going to do some sort of a conversion, let's say you want to convert to a Roth from a traditional IRA, if you do that today, which you certainly can do, it's going to be taxable in 21. You can't make it for 2020. But this gives us a lot of different options here because these are the maximum amounts that you can contribute to different types of plans. Notice here with these two plans, the 401ks, the contribution amounts are exactly the same. The only question is this going to be a Roth, which is not tax deductible, or is it going to be a traditional type 401k, which is? Now, these amounts go up slightly, so I kept the 2020 numbers up here, but basically you're just talking about a $1,000 increase into 2021. And so you can see here, the amounts really don't vary that much. Just understand that you may still have options as far as what you can do to reduce your tax bill, not only for this year, certainly since we're in 21, but for 2020 as a way to, again, retroactively go back. contribute to a business plan and an IRA in the same year, so they're not mutually exclusive. But let's take a look at this as far as just a hypothetical and a potential situation here. And, as Don has mentioned, I don't prepare tax returns anymore, so I'm definitely not looking for any tax related business. But let's say that I was preparing this tax return for a single individual. She comes into my office making 300 grand a year, so doing quite well, obviously, has some itemized deductions. But since it's a W-2 income, there's no real business deductions or anything else, has this high taxable income. And I show her the bill and I say, okay, this is your situation here. You're going to pay about 30% of your taxable income to the government here. And you get the look of, oh my God, what can I do about this? So what if we're able to take a look at this person and say, all right, what if you now make a Semp contribution? So we still have over here the same income. We have the same Schedule A, but in this case, she made a $50,000 Semp contribution. Now this could be 500, it could be 1,000, it could be 20,000, it could be up to whatever the maximum is. So for this particular case, we said, all right, we're going to go 50,000 here. What does that do to my tax bill? Well, the state, I'm just approximating here at 5%, but the total income tax here goes down by almost $20,000. And so even if we put this Semp contribution into a money market that basically received $1 of interest, let's say, the tax savings here, based upon the fact that this person as a single individual is going to be in a 35 or 37% bracket, probably a 35%, but with the 5% state tax rate, we're actually getting a 39.4% return on the Semp contribution this year. And if you think about, I think it was 2 weeks ago, listening to Mike Koval's webinar that he did, and he does a lot of options trading, and that's who I follow quite a bit and use his materials and his advice really to be able to successfully trade for myself. But think about the tax savings here. We're already getting this 39% return just based on the savings here. What if now you're able to take this 50,000 here and turn it into, a lot of money? Okay, I don't know what you can turn it into as far as options go, or stock trading or whatever else. But the point here is that you've got an opportunity to reduce your tax bills from 2020 today. And whether you want to do this or not, of course, that's going to be up to you. So, let's look now at some strategies that we can implement for our tax day, again, coming up in 6 weeks or so, and beyond the rest of this year. And this is really what Don mentioned, the 3-day asset protection event that's coming up in, the end of this month, the 22nd, I guess, of April. But the two things that I'm going to be really speaking on are, what can we do as business owners, and this is day one, and individuals on day two, but what can we do as either business owners or individuals to plan for our taxes in 21 and also in 22, with the assumption that the taxes are going to be going up. Okay, and I think that's a pretty fair assumption after looking at some of the bills that are going to be coming down the road here on the infrastructure and ways to pay for some of the Biden proposals on the different plans that he has in place. So I think you're going to see tax changes and taxes going up in certain situations. And so that's what I'm going to be focusing on at the 3-day event. So I won't be talking about a lot of the stuff tonight. And what I want you to consider, I think, for this evening is that, who are you as far as the type of taxpayer? And, if we look at this box here, this is where all of the tax deductions are going to come. So if you're an employee, there's no tax deductions. And of course, if you're receiving retirement, IRA distributions, maybe a pension, you have what's called 1099-R type income, all that's just going to be taxed without any deductions. But if you're in this box here, where you file a Schedule F as a farmer or a Schedule C as a business, a small business owner, or maybe an LLC, or you get this K1 from an S Corp, or you have a C corporation, all these different types of structures are going to get you into different, I guess, boxes or different pots as far as the taxes are concerned. Now, you may play a lot of these different roles. So, for example, myself, yes, I'm a W-2 employee of a S corporation and of a C corporation, and I am an investor, and I am an investor. I don't do any farming, but the bottom line is that we may wear a lot of different hats, and which hat we wear is going to have a big impact on what we can do with taxes. So let's start with some of the individual changes here as far as this year goes. We are seeing a small bump up in the larger standard deduction. But what I want you to consider here is that if you're really close to this amount, so let's say that I'm married and I filed jointly. So this year, I've got to have a little over $25,000 of itemized deductions in order for me to itemize. Otherwise, if it's less than this, I'll just take the standard deduction. So what we may want to do here is look to bunch some of these deductions together. And again, I'll be talking about that at the 3-day event, because ways to get your tax bill down in 2020 is going to be real difficult, obviously. 2021, we have plenty of time to plan, but we may not have a whole lot of time to plan for 22 because we may not know what the tax law is going to be until late in the year. So again, keeping everything flexible is going to be huge as far as, keeping our options there, basically, depending on what the law does, what the changes are. Understand though that if you are not itemizing, okay, so you're single and you're going to take this 12 grand, or you're married and we're going to double that to this 25-1 here, we can also claim this additional 300 or 600 again if you're married of cash donations made during last year or this. Okay, so this is in excess of this $12,550 that we see here for the single folks. Okay, so that number can go up to $12,850 with this bump up. Don't miss this. One of my main points with tax planning is that you don't always have to hit the grand slam. In this case, we get to deduct, let's say, another $300. What have we done there? Well, we've probably saved ourselves somewhere between $50 and $100 of tax. The question is here, do you want that 50 or $100, or do you want to let the government have it? That's your choice, because you don't have to claim the deduction. But in my opinion, beating the IRS and winning the tax game involves winning small, okay? Getting a lot of singles, getting a lot of doubles, to use a baseball analogy, so that we can basically get every single tax deduction that the law permits. And so we're not going to leave anything on the table. Now, if we itemize our deductions, not only do the people who don't itemize get this bump up on their charity, but if you do itemize, we have a really big opportunity here. The law was that you cannot donate more than 60% of your adjusted gross income every year and get a deduction. So if you donated more than that, you'd have to take it over the next several years, over the next 5 years. For 20 and 21, this 60% limitation has been removed. Okay, so now there is no limitation and you can deduct all 100%. The question though here is, do you want to do that? So let's look at example 3. So this person has an adjusted gross income of 200 grand. They take off their itemized deductions here of some mortgage interest and some state taxes, and they're left with $175,000. Let's assume that they made this donation. They could take a full donation this year and pay nothing in tax. Okay, so this is not a misprint here. They could totally zero out their tax bill. And if they were limited to the 60% deduction, they would have paid almost $7,900 in tax. So we can see here that they were able to save everything basically by making a huge charitable donation. But do we want to use it? And the reason I say that is that we can elect to keep the 60% limitation. Why would we want to do that? Well, we're going to owe this tax, but look at the tax rate here, 14%, 14.3% at the IRS, maybe another whatever at the state level. We can then carry this $55,000 amount, okay, which we haven't used yet, right? We have 175 here. We've used 120. We have 55 left over. That goes into 2022 when we're anticipating tax rates to be higher. And so this is something where you may want to elect to pay the tax today and save more tomorrow, in effect 2022, and not, and not get the full deduction. So again, this is a choice that you have. And again, it's really up to you with the taxes. A lot of us think, the tax law is black and white, not much we can do about it. It's like, no, you've got a lot of options. You've got a lot of different possibilities. All right, so moving along now from charity to the March 21 plan. And this is what I was talking about before as far as some of the legal changes that came about. This is the American Rescue Plan, and this is the one that produced the third round of stimulus checks. So as this little chart shows us, I guess here, a lot of the money went out to the stimulus checks. In fact, I don't know, quite a bit of it, about 25% or so. But we see a lot of other places where this is going on as far as where the money is going. Tax credits over here, getting schools reopened, going to veterans, we're talking about farmers. I mean, so this was a really widespread bill as far as where the money is going to and who the bill is attempting to assist here. And, I think that this one is really interesting because a lot of the comments that I've gotten, and I've been on several TV shows over the past, 6 weeks or so. And, a lot of the comments is that the tax law here is a lot of social engineering, right? That we're using the tax law for social purposes. And that's exactly what the tax laws have always been. And so it's interesting to see, here's our Tax Cuts and Jobs Act, which came about in 2017. And this is still in place. Okay, so the effects of the Tax Cuts and Jobs Act, which clearly benefited the business owners. You could say also, well, people making more than 75K, but this was a really business type of a tax plan, where the American Rescue Plan, the one that just came out again a month or so ago, is really focusing on individuals. So you don't see any of the business provisions or any of the tax cuts for the higher income folks. So the net effect on this, pretty comparable, a $1.9 trillion effect here, tax cuts with the spending about 1.9 trillion. Again, just associating this in different ways. So this is one of the big changes that came about, and this will impact people certainly for 21. And this is the child tax credit. And what these phase out amounts are, and you can see that the number went up quite a bit from this $2,000 and then up to either 3,600 up to age 5, or from 6 to 17, $3,000. So quite a bit. The phase out amounts are adjusted gross income. So if you are single and you make less than 75,000, now again, that's adjusted gross income, not taxable income. But if you make less than the 75 grand, you're going to get the full amount. Okay, and if you're making between 75 and 200, you're going to get a reduced amount. And once you hit this $200,000 amount, you get nothing. And then these amounts for married couples are just simply doubled from the 75 and the 200. So again, this is a major expansion of the child tax credit. And it's also a major change starting in July. And this is something the IRS has not publicly, at least for any of us tax nerds like myself, has not publicly revealed how they're going to do this. But in July of 21, there is now going to be a guaranteed, and I put this in parentheses, small income for families with children. So this is going to be an advanced credit, an advanced payment, again, starting in July. This is something that, we'll have to watch out for. And my guess is that when I do the 3-day event in June, I'll have an answer to that question, or to this question. But again, child tax credit has been expanded, earned income credit been expanded, dependent care tax credit been expanded. So if you've qualified for these in the past, you're going to get a bigger tax credit than you have in the past. And if you haven't qualified for these in the past, you may qualify for them now. Other credits, and again, these are credits much more important than deductions because the credits reduce your bill dollar for dollar. So if you get $1 tax credit, your tax bill is going down by $1. Where if you get a dollar tax, a tax deduction, let's say of $1, your tax bill is going to go down maybe 20 or 30 cents. So we like these credits, and these credits here, and we'll get into a lot more detail on these when I can go through the personal presentation on the 3rd day of the 3-day event. But in this particular case, all of these types of tax credits apply for your personal residence. And some of them can apply to second homes as well. Most of the time, these are not going to apply to new builds. They're not going to apply to rental properties. But again, if you're thinking of looking at some roofing or perhaps doing some insulation or some HVAC work or something on your primary residence, 2021 is a good year to do that because we have tax credits available. All right, a few other things I want you to think about as far as some of the tax changes that came about last month. The law did not include federal student loan forgiveness. Okay, so there was talk that the Biden administration was going to have something in this bill that was going to forgive federal student loans. That did not happen. What the bill did do, though, is that if you do have student loan forgiveness, so let's say a lender says, okay, you don't have to pay $10,000 of your student loan, in the past, that would be taxable. Now, through 2025, it's not taxable. Okay, so that gives us a real nice opportunity here that if you can, if you do have student loan debt and you can get the lender to forgive that sometime in the next 4 years or so, best time to do it because you're not going to be taxed on whatever that amount of forgiveness is. So I've gotten a lot of questions about the stimulus payments. And again, I don't want to spend a lot of time on this. I've done, I think Don and I did a webinar on this towards the end of last year. But real quick, this is what we're looking at as far as the 3 rounds of economic stimulus payments. So round 1 had income phase outs. And anytime you see these income phase outs, these are going to be adjusted gross income, not taxable income. Okay. But understand that if you did get this $1,200 or you're married and maybe you got $2,400, or maybe you have 1 child and you got $3,000, whatever it is you got is not taxable income. And if you didn't get this, but were entitled to get it, and this is something that you need to talk to your return preparer this year, is to make sure that if you didn't get it and you were entitled to, that you claim the credit on your 2020 tax return. And that's real key because you may be entitled to a several $1,000 tax credit depending on your financial situation. Round 2, $600 per family member, so not quite as attractive, but this came out in December of last year. Phase outs again apply, a little bit smaller amounts as far as the phase outs go. And again, if you receive this $600 check, again, let's say you're married and you have one child, so you'd get $1,800 for the 3 family members. That is not taxable income. And if you didn't get it, again, you're entitled to the credit. Here's round 3. This was the one that again came out in March of 21, our American Rescue Plan. This is $1,400 per family member. And children are included. Again, phase out. So starting to sound like just putting myself on repeat here. But notice the phase out range, much smaller here. And for the 3rd time, not taxable income. If you don't get it and you're entitled to it, you can, when you file your 21 return, let's say this time next year, you are entitled to claim the credit. But again, if we can get the money now, let's get it as much as, get it as soon as possible. So some things that I want you to look at here, commonly missed tax deductions. We want to claim every tax deduction that's available to us. I just mentioned some of these stimulus tax credits. If you didn't get them and you're entitled to, claim them on the return. Let's look at claiming a home office, especially with all the people that worked at home this year. Is it possible for you to claim that home office? A lot of people have been refinancing at least in Denver where I live, a lot of the real estate market is insane. So a lot of different people have been buying homes. So points paid. This is something I see missed all the time. Tuition and fees and college expenses as well. Make sure that you give your preparer all of these and let him or her make the decision on whether you can deduct it. Let's make sure that, if you have a rental property or you have a small business, that we claim every tax deduction available. I mentioned the unemployment compensation at not being, or at least part of it not being taxable, but let's also make sure that we deduct any retirement plan contributions, that if we do have gambling winnings, that we can deduct our losses, at least up to the winnings. These, again, are really commonly missed, and they cost you a lot of money. The last one that I want to mention here is the qualified business income deduction, this QBI. This I've seen, and I've done a little bit of tax planning for some friends in Florida, for some friends in Illinois, and also in Colorado here. And all 3 of them missed this QBI deduction. This is up to a 20% tax deduction. It can apply to an LLC, can apply to an S Corp, and then it can apply to real estate investors. But yet, so many real estate investors don't understand that if they have these 3 little rules satisfied, this is an and here, so we do have 3 little rules, but if you have rental properties and you're keeping these separate books and records and you're expending at least 250 hours, okay, so 5 hours a week over the course of a year, and again, you're keeping contemporaneous records, you get this qualified business income deduction. And this is something that I go into a lot more detail on the second day of the 3-day event, because that's where all of the businesses get tied together. But basically, if you don't have a C corporation and you have anything else for your business structure, you're going to at least be qualify for this QBI tax deduction. And it's 20%. So we're not talking about a real small tax deduction. A couple of other parts of the stimulus payments and the CARES Act, that was one of them that we saw come out last year. Remember that 401k loans are not going to be taxable. Also, that this 10% penalty can be waived for certain of the COVID distributions. Also, and I was looking at this today, there are several states that don't allow for some of the changes that were made, either the one back in March or from last year. So be cognizant of the fact that even though the federal IRS return may give you a tax deduction, your state, depending on where you live, may take it away. Also remember too that with some of the tax breaks here with the IRAs, if you took out a distribution in 2020, you're permitted, okay, you're not required, but you're permitted to repay that. And by doing so, you can then have the distribution basically not taxed. You can also decide that you can have a distribution all taxed in last year or split between 3 years. And this is something where you do again have the option. And so if we take just a quick look here we have Maggie, 30 years old, unemployed. She pulls out 30 grand from her IRA. And this is going to be taxed. Now, she may decide that, she's not going to get penalized the 10%, and she may decide to pay it all back, in which case she won't get taxed at all. But she has the option, if she's not going to pay it back, to have it all taxed last year or to split it. And one of the thought processes here is that she may decide, well, let's have it all taxed in 2020 because I was unemployed. And so therefore my income is going to be lower in 2020 than it is in 21 or 22. Again, that's, one possibility there, but again, this is her choice. Okay. So I want to look also now at income shifting strategies. And this is something that, a lot of accountants, a lot of tax attorneys will talk about, in the sense that, how can we get assets out of our name? How can we get money taxed on somebody else's return? And so what we're typically going to look at, and this is where, not only does asset protection come into us to tax planning, but estate planning also comes in. And so how can we shift income to somebody in a lower tax bracket? Well, we certainly are going to want to look at gifting issues this year, and we're going to want to look at estate planning with the estate tax exclusion. And the reason I say that is because this number for 2021, we know what it is. For 2022, it's supposed to be around 12 million. But when I say supposed to be, I don't know what the tax law changes are going to be. And so again, we may want to look at gifting a lot more than this 15,000 if, we're in the fortunate position of being able to do that. But again, the gifting strategies have to come in this year. And that's because I'm anticipating the tax increases for 2022. So we're going to, again, be very aware of the fact that the kiddie tax applies to minor children and also those in college that you're supporting. So we do need to do tax planning when we're using these gifting strategies. And some of the things we want to look at, unlimited amounts for tuition and medical. But really what we're looking at with the gifting is getting this asset out of our estate and getting it into some other person's estate. So gifting assets from myself to my children also removes the appreciation of that asset from my estate to my kids as well. So if I can do this, it's a really nice strategy, because not only does it help us today in the sense of, look, I can make a gift. Let's say I've got Microsoft stock and it went way up in value. I can make a real nice gift and reduce my current tax bill, or maybe completely eliminate it. Also gives us this intra-family tax planning. So when I talk at the events or any of the webinars on some of the business tax planning, I'm always looking at, well, what's the difference between a C Corp and an S Corp as far as the taxation issues? Here, we're kind of taking that one step further, and we're looking at it from within the family. Is it better that the parents pay the tax or the kids pay the tax? And is that something that we can maneuver to be able to, basically get to the tax bill that we want? Also, if there's a reduction in the estate tax exemption, so if that 11 or 12 million now goes down to 3 million, by doing this intra-family gifting now, filing gift tax returns, we're able to now have this proactive approach. So again, it's something that we're going to want to take a look at. I get this question quite a bit, and the reason I wanted to put the pay your children in is just because it shows that we can, in effect, legally shift income as long as, in this case, the compensation that we pay is reasonable, right? And so this is not a situation where we're going to pay our kids an allowance, but be able to claim a tax deduction, right? This is something where if your kids are working in the business, they have now an opportunity to basically help with the business. So here's an example here, and we've got this really cute little doll, the strawberry doll here, strawberry shortcake, but this is a client here in Denver. And she has a small business where she is buying, and I was not aware of these particular dolls, the lemon meringue dolls and all these little dolls here, but apparently there's some money in it. So we were taking a look at some of the hypotheticals here, and basically with her buying these dolls, reselling them, and has a really nice home-based business here. So what do we have? Well, we have gross income here, and this again, all rounded numbers just to show how this can really work. COGS means cost of goods sold. So she goes out and spends $25,000 on buying a whole bunch of these different dolls and then marks them up. And yes, this is pretty accurate. There is a real nice markup. There's some postage and some other expenses here. But basically, we're looking at a $90,000 net profit. And when you put this income with other parts of the business and other businesses, let's say, and other income sources, looking at basically a 30% tax. So it's about 25% to the IRS, 5% to the state of Colorado. So anyways, this person is going to pay $27,000 in taxes on her doll business. So expensive strawberry shortcake dolls here. But what about if she has 2 children? And what about if this handsome dude over here in the picture here was one of these 2 kids? You know, we have 15 and a 17-year-old. We're assuming that they really did the work, that $12 or $10 an hour is reasonable. They're doing this for 40 weeks a year. That paying them $6,000 and $12,000 is reasonable. Now, assuming they did the work, I don't see any reason why this amount would not be reasonable. But the kids file their own tax returns, and look what happens. They owe nothing in tax. Now, if they have other income, they certainly could. But if this is all their income, they owe nothing in tax. Now, let's get back to our doll seller here. And again, I've added another picture here. But anyways, if we look here, the income didn't change. These 2 expenses didn't change at all. But what did change is now we're able to deduct this 18 grand. And what that does is it bumps the net profit down. It bumps our income tax bill down. And now by paying our kids $18,000 in wages, we're able to reduce our income tax bill by $5,400. Now, I know this is a simplistic, example of it, but again, this is something where this is real tax savings. And what if, the kids then took their 18 grand here and used that for college, or they used it to buy a car? And somebody asks you, or you ask your tax professional, can I deduct $18,000 to buy, to pay for college? And they're going to say, no, you can't deduct that. But if you said, well, can I deduct $18,000 of wages? And they use that to pay for college, the answer is yes, assuming that the wages are reasonable. Now, you may have employment taxes here, so this isn't, again, this is just an example to show that there are many different opportunities for you to bring down your tax bill. Business issues as well. 2021, great year to start a business or acquire rental properties. simply because the tax advantages are so huge with both of these businesses or rental properties. And businesses as well, they can be stock market trading businesses, as I've seen quite a few people do quite well trading stocks and doing that as a living as opposed to an investor. Understanding your tax choices of these two in the red, your qualified business income for flow-through entities, LLCs, S Corps, what have you, or C Corps of 21% taxation, where this number, the talk is 28% for next year. So have the tax plan in place now. Figure out what's going to happen if that 21 goes to 28, and make sure that you know what's available, that all tax deductions that are available you claim. So understand our entity choices here, understand that our plan is coordinated, personal and business, and then within the businesses and within the personal. Again, tax credits are huge. So we want to be able to understand what all of the options are and be able to plan accordingly. And if you go back to that very first slide that I had as far as who you are, I think you can see that, depending on which hat you're wearing, you may have vastly different answers to some of your questions here. C corporation, we have net operating losses that we can carry back. And I'll talk about this in just a minute here. Employment tax credits are beyond confusing, but really, really valuable because it allows us to basically have the IRS, the federal government, pay for a lot of the employment taxes that we're incurring. With the net operating losses, and I've gone through this on previous seminars, but understand that we're not required to carry these back. So, the Congress, they come out, oh, this is a great thing, we can carry it back. Well, maybe we don't want to carry it back. What if we think that 21% rate is going to go up to 28%? Carrying it forward would make the deduction worth 28% and not 21%. Or maybe we're going to have more income in the future. So just because you can do it doesn't mean you should do it. And that's something that, again, tax planning is going to come into play. The employment taxes, I mentioned, this is just a nightmare as far as trying to figure this out. But when we do figure it out, really valuable. It goes through the second quarter of this year, and it increases the rate from 50% to 70%. And it also increases the wages from $10,000 per employee per year to $10,000 per employee per quarter. So you can see that for 2020, $10,000 per employee was the most that we could get this credit for. This year, since we have 2 quarters, we can do $20,000 up to $20,000 per employee. So these credits are huge, and they give you a lot of flexibility. And so this is something where if you have employees and you're filing this 941 form every quarter, you want to talk to your tax pro. You want to see if this safe harbor applies, if you have an appropriate reduction in these gross receipts. All of these things come into play, and you got to make sure that you have a preparer that's really in tune with what's going on. Because look at this, as far as this particular example, we have $10,000 of wages, which means that we would get this credit of $7,000. Now, if let's say I'm the employer here and I've got to deposit, this $9,000 from a bunch of other employees, maybe including this one, I have to deposit $9,000, but I get a $7,000 credit, so I'm only required to deposit $2,000. So that's real important as far as getting credit for this, getting credit for the credits, as a lack of a better way to put it. So be aware, again, that the employment taxes are generating huge tax credits. And if you're not aware of them, you're not going to get them. All right, few last slides here, and then I'll let everybody back to their lives. I know that I'm running out of my allotment here and want to be very aware of everybody's time restraints. But a few other things that are in play here for this year: 100% deduction for business meals. Entertainment is still out, so nothing is deductible for the entertainment. But 100%, so this is up from 50 on business meals. Food has to be provided by a restaurant, includes beverages, and is not lavish or extravagant. But just realize that we do get this bump up for 2021. Also, for the business equipment here, really not much has changed. I'm not expecting anything really from the tax laws to change as far as 22 goes. So I have not seen anything in the Biden administration in their tax proposals that are going to eliminate any of these expense deductions. So Section 179 just lets us buy computers and desks and other types of equipment and not have to depreciate it. All right, few last comments here, I think, and I'll turn it back over to Don and Kendall for the Q&A part here, but some income timing strategies. And this is going to be really big between 2021 and 2022. Do we want to take our Social Security income, or do we want to defer it? Installment sales with real estate. Do we want to maybe tax the whole capital gain this year because the tax rates are going to be lower this year than next, or what we think is going to be the case? Maybe we want to look at doing a like-kind exchange this year with real estate, as like-kind exchanges are on the block right now as far as being eliminated, certainly for those with certain income. So like-kind exchanges may be out for certain income classes next year. Using tax-favored investments, Roth IRAs, SEP plans, whatever there, making sure that we can now have that money taxed either sometime way down the road or maybe never with a Roth IRA. So again, we want to look at some of the retirement options available to us in our planning. Deferring income again, and we can self-direct this. This is real big. You know, I've seen some of the presentations, and when I have an opportunity again, I guess to go to one of the live events and see Jill Banner, she talks a lot about the self-directed IRAs and all the things that you can invest in, that you're not limited to what, you know, Fidelity or Vanguard or TD Ameritrade says that you can trade in. So all of these things, as far as when to claim the income, you know, do I want to use an opt zone to be able to defer or eliminate capital gains? All of these come with choices, and you need to be aware of what these choices are. And so again, get yourself with a good tax pro, because it's absolutely critical. Make sure you review your return. Do it a few times. I know that it's not fun. The forms are complicated. They look different, but mistakes get made. And that's true whether you're doing this on TurboTax, you know, or whether you have somebody do this for you. File even if you can't pay, because the extension to file does not extend the time to pay. And if you need more time, certainly file the extension. Your return can always be amended if there are mistakes. Okay, so we're not going to worry about that. We want to file the correct return, but if you miss deductions or you miss income, you can always file an amended return. And then the last thing for this particular tax season, I guess, is look at the married filing joint versus married filing separate. You can do this and switch back and forth, and there's no rhyme or reason to it. When you file separate, that does not mean that you're in a situation where you're divorced or you're going to get divorced or whatever. Have your preparer use the software and determine, well, what's my tax bill if I go joint versus separate? And let's see, maybe there isn't a difference. But for most of us, filing joint will be the best way to go, but not all of us. And a lot of tax professionals use the married filing joint as the default. So again, let's make sure that we're taking advantage of all of the different possibilities here with the planning. And so anyways, I've kind of hit 7:30, which is right at the time that I was supposed to end. So there you go, Don. There you go, Kendall. I'm going to leave you here with this little quote from William Buckley, who I kind of agree with there. Don't ever use the word fair with me in taxes. It's not fair. I know it. So anyways, those are my thoughts on tax day 2021, and I will throw it back over to my good friend Don here.
All right, Scott, thank you very much. And we've got a lot of questions, and I think a lot of them came in before you kind of set up the rule. Let's stick with the topic that we're talking about tonight. So do you want me to skip over those, or do you just want to hit those real quick?
No, I think we skip over those and let's get to the questions that I haven't answered that, relate to something more specific to tonight.
Okay, Melanie asks, who qualifies to contribute to a Semp IRA?
Well, Semp IRA, you're going to have a business there. And so, it's not going to be your traditional or Roth IRA, but you're going to have a business. You're going to pay yourself some wages, or you're going to have a Schedule C business, and either one will now qualify you for a SEP. So if you can qualify for a 401k, you can qualify for a SEP. They're basically the same thing from a tax perspective.
Great. What are the considerations you might want to consider when you're taking Social Security?
Well, you're going to have an option as to when you're going to take it. So I think you have two different options, or two different things I think you want to look at. One is the financial situation of, if you take it at the earliest age possible, or you wait till the latest age possible, what's the difference in the monthly payments and what's your break-even point? The other thing you want to consider, though, is that, if you're taking Social Security now and you're still working, some or all of that Social Security is going to be taxable to you. So it may bump you up into a higher tax bracket. So I don't typically recommend Social Security in taking it until really your income is down and you need it for what its purpose is.
Okay, good. Can we deduct gambling losses other than Schedule A?
No, I mean that's where they're going to end up on Schedule A. So if you don't itemize, you're out. The only other thing you can do is be a professional gambler, in which case your expenses go on Schedule C. I really don't recommend that, right? I mean, if you're trying to make a living gambling, good luck, so to speak, right? But there's court cases that say you can do that. I have yet to do a tax return, and obviously I'm not doing them now, but in my entire career, I've never done a professional gambler tax return where there was a net income.
All right. Cindy's asking, what type of home office deductions can you claim if you're a K1 from your own S corporation?
And that's going to be really difficult. When you get into the different entities, like an S corporation, you have different rules that come into play as far as what are called accountable plans for expenses. But you can certainly do that. You're going to have to look at the home office deduction and reimbursing yourself from the S corp. Now, whether it's worth it or not, that's kind of a 50-50 shot there. Where the home office really comes into play is when we file a Schedule C. And that's going to be either a sole proprietorship business, which, from an asset protection standpoint, I would never recommend. But you see single member LLCs all the time file a Schedule C, claim the home office. All you have to do is prove you used it regularly and exclusively for business. And you're going to qualify for a deduction of things you're already paying, portion of your insurance, utilities, things like that.
All right. So if you're getting income from your own C corporation, rather than trying to deduct home office personally, you would invoice the corporation, let the corporation reimburse you rather than taking a home office deduction. Same thing with an S corporation. Would that apply to partnerships as well?
Yeah, it would. Basically anything that's not going to pop up on a Schedule C. I think that's what you'd be looking at there. But I see a lot of people not taking the home office, or like you mentioned, Don, you have a C corporation. So just for everybody on the webinar, C corp taxed on its own. Microsoft, Intel, all those companies are C corps. They pay rent. Well, what about if your C corp is using your office? So it's kind of the same thought process, just a little bit different way of getting the deduction.
Okay. Somebody is asking, did I hear right? Replacing all the windows in the house will be credited dollar for dollar. That's not what you said.
It might have been what I said, but if it was what I said, yeah, it's not what I meant.
Okay.
So so if you do all the windows in your house, let's say it comes out to $10,000 or 50,000 or whatever, whatever the number is, there's a cap on that. And so let's say the cap is $500 or whatever. And again, I'll be getting into that a lot more at the 3-day event. I have 6 or 7 slides on that topic just to show you. But what I did say is that a credit does reduce your tax bill dollar for dollar. So if let's say you put in $5,000 of windows, government says there's a $500 maximum credit, you would get to reduce your tax bill by $500.
Not your adjusted gross income by $500. Correct. Yeah. Okay. Got it.
Uh-huh.
Okay. Why are financial advisors no longer a write-off? Is there any other way to write off their fees?
Well, the reason that financial advisors are no longer deductible is because on a lot of the tax changes with the Tax Cuts and Jobs Act, they eliminated the miscellaneous itemized deductions. So your safe deposit, your tax prep fees, your advisor fees, all of those things are no longer deductible for a person, right? For an investor. But what if a business, so what if your business is, I'm a stock market trader and now I pay, let's say Mike Koval $5,000 for some training. Is that deductible? For a trader? Yes, it would be. So again, when you go back to one of my first slides tonight, who are you? If you're a stock market trader, that becomes deductible. But if you're a stock market investor, Congress took that away in the Schedule A.
So, Scott, what one of the things we teach at the 3-day summit is to hold large brokerage accounts in, let's say, a limited partnership or an LLC. Now it's deductible to the business where it may not be deductible to you personally. Is that correct?
Yeah, I mean, if you can show that expense related to the business, then it would qualify as a deduction for the business. Yeah.
Okay, good. Okay, question from John. Can a Roth IRA contribution be a deduction?
No. By definition, anytime you do a Roth, whether it's an IRA or a 401k, you're basically saying, look, I don't want the tax deduction today. I'm good with that. But then again, I don't ever want to pay taxes on this money again. And so, you take, let's say you have you have $10,000 in an IRA, and you now turn that into $1 million. If it's a Roth, you'll never pay taxes on that $990,000 that you made. Okay. Whereas if it's a traditional one, you may have got the deduction up front, but now you're going to pay taxes on the back end. So it's one of those where you're going to pay taxes one way or the other. Do you want to pay them now or do you want to pay them later?
Yeah. And so, John, the way you worded this, can a traditional IRA be it, your contribution be deducted? Yes. But for a Roth, no, it wouldn't be a deduction. Traditionals, you get the tax deduction. Roths, you get the tax-free environment. Well, both of them are tax-free environments, but you'd have to pay the taxes on it right now. Okay.
Yep.
Can I contribute to a Roth IRA if I made more than $150,000? If so, how?
Well, and I don't know what the income level is this year, but there's a cap, and I believe it's more than 150. I want to say it's like 180 or something. But let's say I make 300,000, The answer is no, I can't make a direct contribution to a Roth. One thing you can do, and this would get way more complicated than what we have time to, is make what's called and do a backdoor Roth, where you make a contribution to a traditional IRA and then convert that to a Roth and pay the tax at that point. It gets quite complicated because the value of all of your IRAs come into play. And so it could produce quite a big tax bill, but it's something that it's an option that's available. And depending on how many years you have before you're going to need the money or what your income is today, if it's low enough, that might be a nice option.
Okay. SK, the deductions for tuition you mentioned, can you clarify what types of organizations qualify? Example, education from private companies. It has to be an accredited university or college. You have to be working toward a degree program, right?
Yes. I was thinking, from a reimbursement from the company. But no, if you're looking at like a company that's doing education, that's not. So it's going to definitely be degree accredited.
Correct.
Like you mentioned, Don.
Okay. So there's some rules on educational expenses. But what we often do is if you've got, let's say you paid for stock market trading or real estate trading, and they're not an accredited university, it's not toward a degree program, but we could create a business and write that off perhaps as a research and development expense out of the business where education may not apply. There's some workarounds that we might be able to do, but strictly as an educational expense, the rules are really restrictive on education, are they not?
Well, they are, but and a further point on that too is, something like my continuing legal education, that's all through, they're not accredited schools, they're different bar associations and whatever. And lots of us CPAs, attorneys, real estate agents, anybody with a license, you may have to do continuing education. Those are all going to be deductible as well through the business. Not if you're a person, they're not deductible, but the business, they're deductible.
Okay, good. Carla is asking, must IRA contributions be from W-2 income? No, just earned income, right?
That's right. Earned income. W-2 is the most common earned income, but you can have self-employed income as well.
Right, but
No.
not passive income.
Correct. Yeah, if you just have interest, dividends, things like that, that's not gonna qualify.
Okay, Scott, do you help with installment sales in real estate? No, you're retired.
Yeah, I'm retired now. Actually, that's not something that, that's something that should be fairly straightforward, because it's a math problem. How do you want this taxed? When do you want it taxed? Where do you want it taxed? So, your tax professional there ought to be able to walk you through the different scenarios and see, the math may say, yeah, you definitely want an installment sale, or you definitely don't. But that's just run the numbers.
All right. Laura is asking, please elaborate more on employment tax credits. Are you going to hit that more at the summit on the second day?
Actually, on the first day, no, I'm sorry, the second day of the summit, my first day of speaking, yes.
Right.
I'm going to be, that's where it gets really complicated because you have different employees who are making different amounts in different quarters with different tax credit amounts. And so I'm going to go through about 6 or 7 different slides to show the examples of how those play out. I think for purposes of tonight, just understand that if you have employees and your business has suffered some reduction as a result of COVID in 2020, 2021, over 2019 and 2020, you're going to qualify for some tax credit, and you need to be aware of that with your tax pro. Or again, I'll be going over that at the summit.
Okay, great. Nancy's asking, how did American Rescue Act impact premiums paid for Affordable Care Act insurance? How did American
That is a really good
Act...
question. I don't know the answer.
Yeah.
The American Rescue Plan is the one that was just passed in March, and I did not see anything when I read it. And I didn't read the whole act again today, but I did go over it. And I didn't see anything on any of the Affordable Care Act. That's the Obamacare plans, where there was a difference in how the credit's going to apply to help people pay for the health insurance. But I can't answer that question because I don't recall seeing anything.
Okay. Will this webinar be repeated? Kendall, maybe you can chime in on this. This is being recorded, and I believe it'll be sent out to anybody who registered for the event. But it'll probably take, most likely it takes about a day before you send that out. Kendall, tell us what your plan is for this.
Yeah, so once the recording is available, probably tomorrow morning or tomorrow afternoon, it'll be sent out to anybody who's registered for the webinar. We always suggest now, just to make it easy on yourselves, make sure you sign up for our YouTube channel, subscribe. So when you go to Protect Wealth YouTube channel, Protect Wealth Academy, you'll see a subscribe button and you'll get notifications immediately. And that's always nice, just convenient. But other than that, we'll send you an email tomorrow.
Okay, and if you're like me and not sure how to do it, simply go to YouTube, type in Protect Wealth Academy, and a big red button will show up when our website shows up and it says subscribe here. Hit that, and then you'll be notified whenever we post something new. So, okay. Done. Can I get QBI deductions even if my business has had a net loss in 2020?
QBI deduction only applies to net income. So it's not going to help us in a loss, but the loss can be used then to offset other income. So you'll get the benefit of the loss even though no QBI.
Okay, good. Okay, if I purchased a used vehicle for my business in 2021, can I deduct up to $18,100?
Yes. Yeah, as long as you didn't buy the used vehicle from yourself, you're good to go.
Okay, good. Thank you, Jim. Okay. My granddaughter needs to see this. That's good. Gigi, I haven't seen you on a webinar for a while. It's good to have you back. Is there any way to deduct property taxes other than through itemizing?
Well, your property taxes, if it's a business related property tax or a rental property related tax, sure. But if let's say that you have property taxes on your house of say $5,000, you don't have any mortgage or anything, so you don't have enough to itemize, then the answer is no, you lose that deduction.
Okay, got it. Yep. There's a lot of things that got taken away when they raised the standard deduction. When they doubled that, a lot of people, charitable donations and all these things was on your Schedule A. You're getting the benefit because the standard deduction went up, but it takes out property taxes for a lot of individuals, doesn't it?
It sure does. I mean, and I guess the IRS would say, hey, you're allowed to deduct those property taxes if you want to, and go ahead and itemize, but you're going to get a lot less of a deduction that way. So yeah, either way, you just look at it and add up all your itemized deductions, look at the standard, and whichever one's bigger, that's the one you take.
Okay. Dan, a stimulus payment was not received. Can it be itemized as mentioned? But what about a federal tax refund not? Dan had asked a question earlier. He didn't get a tax refund, even though they filed a tax return, but the IRS didn't pay him. His accountant has questioned the IRS a couple times, but they're not responding. How do you get the IRS to respond if they owe you money? Any ideas?
You threaten them.
You get a bigger attorney.
Yeah, that's right. Yeah, you get a bigger gun than they have, I guess. What, and I've seen this before too. The IRS is operating like a lot of businesses right now, and everything at things are messed up at the IRS with COVID and people working at home and whatever, that refunds are taking a lot longer to get. If you have a problem like this where you're entitled to money and whatever, that things that you could get back in 2 or 4 weeks are taking 2 to 4 months. So I think what you need to do there is be patient. And if the IRS doesn't reply back to you with what you think is a reasonable amount of time, then again, you just have to, keep pestering them, send them another letter. This is my third attempt to get this refund. I have not heard from you, and at some point you may have to sue them. But, with COVID and everything, I've just seen a lot of things taking a lot longer than they used to.
Okay, good. Laura's asking, she says she's got a primary residence in Connecticut, second residence in Vermont. Can she take the renewable tax credits on her second home in Vermont?
Yes. Yeah, actually you can
Okay, good.
on that.
Good.
So Don, let's do 2 more. Can we do 2 more questions?
more.
Because I've
Yep.
got a call at 8 and I need to
All right.
switch over for that.
So I got as many as I can. I apologize if we didn't get to all your questions. Scott will be back for us in 2.5 weeks at the 3-day summit, and hopefully answer a lot more questions. He'll be speaking for over an hour on reducing your personal taxes and about an hour on how to reduce your business taxes, and hopefully that'll get more questions. Unrealized losses on stock investments. How does that work?
Well, if you have an unrealized stock loss, all that means is that you have a position in your brokerage account that you haven't sold the stock yet. And so you're sitting on a loss. And what a lot of times we like to look at with unrealized losses is that if you have a big gain, we may be able to look at the loss and say, all right, what if you sell 100 shares of this stock, take $1,000 loss, and then use that to offset any gains? And so it gives us a planning opportunity, but only realized gains or losses count for taxes. So if it's unrealized, it's just paper at that point.
Okay. So Joe's saying, I'm a W-2 employee with a large company which offers a 401k and a Roth 401k. Can I do a mega backdoor Roth conversion totaling 58,000 for 2020? So his company's already contributing. Can he do a mega Roth conversion? It doesn't look like they're doing Roth. No, that's not true. He's doing the company's doing a 401k and a Roth 401k.
Well, if the company allows you to do that, so they have a 401k plan and then they have a Roth 401k plan. And so you put the maximum into the 401k. If you convert it, you can do that. I mean, again, if the company permits it, but you're going to need to look at the tax bill, because you first of all, you were able to not have that $58,000 in 2020 taxed. So you're basically excluding that. Now, if we convert it, you're going to get a tax bill in 21. So you may want that depending on what your income is going to be in 22. But I'd be really careful about that, because that could generate a lot bigger tax bill than you might think.
And the company might have some restrictions, especially if he's still with the company. They're doing a 401k and a Roth 401k, and they might be more restrictive than the IRS is.
Yeah, I think that, they may just say, no, you can't do that. And even though the tax law permits it, the individual plans may just say that that's not a part of our plan, or they may not have the means to do that. And companies have that, that right to be able to, put some limitations on these plans.
Correct. All right, Kendall, if you would do something, if people are not yet registered for the 3-day summit coming up in a week and a half, would you put in a link so that they can do that? But short of that, if you're listening by phone or something, you'd go to protectwealth.com and simply register for the upcoming summit. It's a Thursday, Friday, Saturday event. We've got a tremendous lineup of speakers. Clint Coons, Scott Estill here, We've got Kwame Granderson. We've got some amazing attorneys. And then we've got some amazing speakers. Mike Koval has mentioned several times will be on. We've got, it's going to be an amazing lineup. So you get more details at protectwealth.com. And Scott, thank you so much for your time. Both here tonight, as always, and on the summit. And we'll answer hopefully a lot more questions than. But thank you for your participation tonight, and Scott, especially thank you for your time.
Thank you, Don. It's always my pleasure. And any of the questions that I didn't get to tonight, I can certainly look at those and try to get those answered during the 3-day as well. So, but again, thank you everybody for spending a part of your evening tonight, and hopefully, we can get our tax bill down to the absolute lowest possible minimum, right? So thanks again,
All right.
everybody.
Thank you. Have a great night. Bye-bye.